Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 118. I'm Jesse Kramer. By day, I work at a fiduciary wealth management firm helping clients nationwide. You can learn more at bestinterest.blog/work. The link is in the show notes. And by night, I write at the Best Interest blog, and I host this podcast, Personal Finance for Long-Term Investors. I help busy professionals and retirees avoid mistakes and grow their wealth by simplifying their investing, taxes, and retirement. Today is our 9th AMA episode, yes, an Ask Me Anything episode where we dive deep on your questions in the world of financial planning, investment management, retirement planning, all those kind of juicy topics. But first, we have a review of the week from Bike Guy. Bike Guy says, solid and clear advice. I'm glad I came across this podcast. The information is always spot on, clear and concise, and helps me make better personal finance decisions. It may not be the most entertaining thing to listen to all the time, but I don't think I've come across a finance podcast that so consistently delivers accurate and helpful information. Keep up the great work. I'm definitely going to keep listening. I think that's actually a good thing. I'm not sure I want this podcast to be the most entertaining thing to listen to all the time. You know, I don't have the Jim Cramer sound effects going on. But the fact that Bike Guy says I'm consistently delivering accurate and helpful information, that's the name of the game. That's it, right? That is the name of the game. So Bike Guy, thank you for those kind words. I'd be happy to send you a super soft podcast t-shirt. Please drop me an email to jesse@bestinterest.blog. And listeners, if you have a question or a concern or feedback that I can answer, especially for a future Ask Me Anything AMA episode, please send those questions to my email address, jesse@bestinterest.blog. So the first question is from Jim, and really it's more of a comment than a question, but we're going to use it as a springboard to start today's episode. I wrote an article about a month ago, and I can link it in the show notes. It's called Stocks for Growth, Bonds for Sanity. And Jim commented on that article, and he said, as all you quote-unquote advisors do, you never understand time. At age 30 or age 40, you go all in. At age 73, diversification rules. Preservation, not growth, is more important. Time is the variable that no advisors seem to get. Well, I kind of laugh at Jim because I'd argue that time and timelines is probably one of the foundational considerations in all my financial planning work. And if there's any topics that listeners and readers might be sick of me talking about, it could be time and timelines. Diversification, a huge factor too, and something I think I do a pretty good job talking about. Then Jim's comment might out him as a bit of a newcomer to my content, but even then, I think Jim's comment needs a little bit of massaging, and I think we can all learn something from Jim's comment. So, for example, he says, at age 30 or age 40, you go all in, meaning your investments should be all in, kind of aggressive, high octane. And I say not necessarily, Jim. You know, if a 30 or 40-year-old, if they're saving for a housing upgrade or a new house they want to move, if they're saving for their kids' college, well, those are probably short or medium-term expenses that they're saving and investing for, but not in an all-in fashion. And then Jim goes on to say, he says, at age 73, diversification rules because preservation, not growth, is more important. Again, I would disagree here, Jim. It might be true for Jim himself, but not for all 73-year-olds. I know plenty of mid-70s folks who ought to be thinking of part of their family wealth as being short-term, medium-term, so that they can fund the remainder of their life. But then part of their family wealth as being long-term for their kids, for their grandkids, for a charity after they pass away or something along those lines. And for those people and for those purposes, for those reasons, for those goals and those timelines, growth is actually more important than preservation, even at age 73. Again, I'm being a little facetious here. It's almost as if the individual investors or the family's goals are the most important thing, Jim. Those goals come with specific timelines and dollar amounts needed. Those timelines and those needs inform the appropriate amount of risk one can take and the reward that one should seek from their investing, which of course informs which types of assets, which asset classes are appropriate for that goal. And maybe some advisors don't understand that idea, Jim, or prefer to invest in some way that doesn't account for their clients' unique goals or timelines. And that's their prerogative, their business, and it's up to them to explain that to their clients. But personally, my financial planning and investment approach, and that which I encourage any DIYer out there to follow, is highly dependent on time and timelines. Diversification, of course, is important at all ages, in my opinion. Diversification might be the only free lunch in investing. And I think it's always worth revisiting that basic tenet of investing, that relationship between risk and reward. And it really does start with the basics. High reward comes from taking risks. Small risks, though, or no risk, lead to small rewards. You can control your risk preference, your time horizon, and your financial goals. But if you demand satisfaction from all three, you might be disappointed. And really what I mean there, we can dig into some more details in a minute, but if you demand a low risk investment that over a short period of time is going to fund lofty financial goals, you're going to be disappointed. You kind of have to pick and choose. And people searching for that low risk but high reward investment, they're kind of seeking some sort of mythical free lunch. And there's no such thing as a free lunch. Although diversification, which we just talked about, diversification might be that free lunch and the one and only free lunch in the world of investing. So again, risk and reward are correlated. All investments come with risk. Now, what does that mean? How do we define risk? It varies, but the popular definitions are that risk is the probability of permanent harm or injury. That risk is relative to time horizons. A choice can be risky in the short term, but less risky in the long term, or vice versa, right? Stocks might be risky in the short term, but most people would say they become less risky. A diversified stock portfolio becomes less risky over the long run. Whereas holding a portfolio of, say, short duration bonds, not risky at all in the short run. But if all you do is invest your money in cash and bonds, that probably is risky or riskier in the long run. So anyway, risk can change over time. And risk, another part of the definition of risk is that it is related to volatility in some way, although many investors, for example, Warren Buffett, would probably disagree with that idea. The whole point is that risk is scary in some way, right? We don't want to lose our money, and risk implies that we might do just that, might just lose our money. So when we're faced with any sort of risky investment, the intelligent investor says, well, I'm going to demand a bigger reward. If I'm going to take this big risk, I need to earn a bigger return. And what that ultimately looks like is, hey, if the return isn't juicy enough, I'm not going to pay that price. I'm not going to pay the price that's being offered to me. There's no demand at that current price. And the lack of demand in this capitalist supply and demand economy, the lack of demand is going to push the price down. And when we pay less for the same investment that we otherwise would have, well, that means that the return on that investment is naturally going to go up. And that leads to this essential relationship, both in investing and in other parts of the economy. But today we're going to focus just on investing, this essential relationship between risk and reward and price. Risk is built into the investment itself. Reward is something that investors must demand, and they make these demands via the price that they're willing to pay. When a reward overcompensates for the risk, intelligent investors are going to pour their money into that investment. And when a reward doesn't really justify the risk, intelligent investors are just going to sit on the sidelines. That demand, or the lack thereof, will push the price of the investment up or down. In other words, price acts as an equilibrium mechanism between perceived risk and expected reward. Some of you might have seen a chart before, a very simple chart that shows risk on the x-axis and returns on the y-axis. And it shows this nice, gently increasing slope. As risk goes up, returns also go up. And then along that slope are different asset classes. Bonds are relatively low or further left on the slope because they're lower risk and lower reward. And as we move up and we move to the right, we hit things like real estate and large cap stocks and small cap stocks and private equity, more risk, more reward. You can almost think of it as a bell curve or a series of bell curves onto this chart. And at the furthest left, again, at the lowest end of the spectrum, at the lowest risk end of the spectrum, the bell curve is very small, because the range of expected outcomes is very small with low-risk assets. But as we move further right, that bell curve grows. It grows in width, it grows in height, because the range of expected outcomes becomes quite large. And in fact, we eventually hit many types of investments where the range of expected outcomes is so large that we might lose most of our money. So anyway, in the show notes, I'll link this article, bestinterest.blog/risk and reward, and you can see both of these charts for yourself. But that leads me to a question, what can you control in this risk versus reward relationship, right? Some things are not in our control as investors, but some things are in our control. And what is in our control is that we have financial goals, we have a preferred time horizon to meet those goals, and ideally we can adopt some particular risk preference to do just that, to meet our goals on time. But many people, including some of us, run into trouble when either our goals are too lofty, our time horizon is too short, or our risk preference is too conservative, right? Everybody wants a high return for no risk. They want that proverbial free lunch, but it really doesn't exist. And if you need high returns due to either your lofty goals or your short time horizon, then you're going to need to take a lot of risk. And if you can't stomach that risk, well, then you're going to need to either soften your goals or lengthen your time horizon. You can almost imagine this little triangle diagram where the 3 points on the triangle are low risk, short time horizon, and large financial goals. Again, the 3 points on the triangle, low risk, short time horizon, and large financial goals. And as you, a person, kind of move around this triangle, as you move towards one of those 3 points, you're naturally going to be moving away from the other two, right? So if you demand lower risk investments because you just can't stomach the risk, if that's the point of the triangle that you're moving toward is low risk, well, then you're moving away from short time horizons and you're moving away from large financial goals. Because in order to reach whatever goals you want with low risk investments, you're going to need a long time for those investments to compound. If you're moving towards the corner of the triangle that, say, is large financial goals, right? If you have these big, lofty financial goals, well, then you're moving away from low risk. You're going to need to start taking some bigger risks. And you're also moving away from short time horizons. If you have large goals, it's going to take you some time to be there. So again, there's this natural trade-off. There's no free lunch except for maybe one. Diversification might be the one free lunch out there. And this comes back to Harry Markowitz, who won a Nobel Prize for modern portfolio theory. And he was the one who first said diversification is the only free lunch. And what he meant was diversification is the only way to reduce portfolio risk, while maintaining returns, to get out the same reward that you otherwise would while also reducing risk at the same time. That's the whole reason why people harp on the idea of diversification. They're saying that a well-diversified, a well-constructed portfolio is less risky than the sum of its parts. That's the essence of modern portfolio theory that won Markowitz that Nobel Prize in economics. The idea is to create a portfolio of risky assets, for sure. They're risky assets on their own, but to ensure that those assets are not correlated with one another, to ensure that their behaviors, their return profiles don't move in tandem with one another, that they don't rise and fall at the same time as each other. Markowitz proved that a diverse portfolio in this way has the same expected returns as a non-diversified portfolio, but at significantly less risk, less chance of going to zero, less volatility along the way. It can be measured using things like the Sharpe ratio. That's the most widely accepted measure of risk and reward in investing. Portfolios that exist on the so-called efficient frontier, they represent the best possible expected returns for a given level of risk. Now, this idea, modern portfolio theory and diversification as a free lunch, it's not without detractors. First, there's the math versus reality argument. Modern portfolio theory looks great on paper in the world of pure math, but critics would argue that it's not as effective in the real world where the psychological irrationality of Mr. Market, all of us in the markets, our irrational exuberance and our panic. When that is at play too, beyond just the math, it's also investor psychology, well, all of a sudden modern portfolio theory breaks down a little bit. Next, some people would claim that diversification simply isn't enough. Nobel Prize winners Eugene Fama and Ken French, they're proponents, for example, of factor investing. In short, factor investing says rather than looking purely at risk, there are other variables that lead to extra investment reward. For example, size. They would say that small caps tend to outperform large cap stocks. Relative price, value stocks tend to outperform growth stocks. There are a few other factors too, quality, momentum, and a few that I'm not going to talk about here. And modern portfolio theory, the diversification theory, if you will, ignores that idea. That might not be a smart thing to do. And then even there's criticism from legends like Warren Buffett and Charlie Munger, who would claim that modern portfolio theory is simply an invitation to buy, to own suboptimal stocks and suboptimal companies in the pursuit of diversification. Charlie Munger and Warren Buffett were pretty famous for having concentrated positions in their portfolio. Rather than owning 50 companies, they'd say, just own the best 3 and ignore the 47 bad ones. Now, how do we identify which 3 are the best? That's what makes Warren Buffett and when Charlie Munger was alive, that's what made them the legendary investors they are. Their consistent ability to identify those 3 needles from the haystack of 50 stocks. You and I, it's probably harder for us to do, and maybe that's why diversification makes a lot more sense on the kind of individual family level as opposed to the giant institutional level, but that's a conversation for another day. Getting back to the point, risk and reward, they are intrinsically connected. As risk increases, investors must demand more reward. And in your investing life, you can control your risks, you can control your goals, you can control your time horizons, but it's impossible to control, to optimize all 3. You're going to have to sacrifice at least one in pursuit of another. And while there's no free lunch, diversification does come close. A well-constructed portfolio of diversified assets can provide investment returns at reduced levels of risk and reduced levels of volatility. So Jim, thank you for the comment and for the jumping off point. And now we're going to go on to question 2 from David. David is almost 47. He would love to retire early. He's got some years of service in the New York State retirement system, as well as in the federal government retirement system. So he's got some pensions looming out there. And he recently inherited about $1 million from his mom. His net worth alone is $1.5 million if you include his house, he says. He and his wife have no mortgage. They have a 14-year-old son. And the problem that David is facing is that he wants to make sure that he, in his words, that he leverages or that he uses the $1 million inheritance now that he's at age 47 in the smartest way possible to build wealth over the long term with the hope of retiring early. So I think it's a very interesting question. Thank you for submitting that, David. Any good financial planning conversation starts with identifying all the puzzle pieces with as much detail as possible. So if we were talking, David, I would want to know more about, say, your pension or pensions, the current ones that you've earned or the future pension benefits that you might earn over coming years. I would want to confirm, again, just from your question, that the $1 million inheritance, is that part of your $1.5 million net worth, or is it in addition to the $1.5 million? So really it'd be more like $2.5 million of net worth now. And beside getting all those puzzle pieces out in the open, I'd want to think about your overall situation to get you retired early. So whenever you choose to retire, David, I see 3 main sources of income for you. The first would be pension payments. The second would be drawing down on your portfolio assets. And that's where things like, the 4% rule or smart, safe withdrawal rates and withdrawal strategies, that's where that comes into play. And then the third income source would eventually, at a particular age, be Social Security. Maybe there are other income sources that I'm not aware of. That's really important to get out on the table. But the interesting thing for David's situation, and for a lot of people listening right now, the interesting thing for a lot of retirement situations is that those 3 factors, in this case it was pension payments, portfolio assets, and Social Security, that they're all subject to change depending on when you choose to pull the retirement trigger. Every year you delay is most likely another year that your pension benefit will grow. Every year you delay is on average another year for your investments to grow, and another year to get you closer to Social Security age, one less year, another way of putting it would be one less year of retirement without Social Security. But, and here's the hardest part, every year you delay is also one less year of life, one less year of retirement, one less year that you'll even need the money at all. It's like a child, I suppose, who's given more and more toys, but is running out of daylight to play with all the toys. Many pre-retirees really struggle with this because we'll only know the right answer in hindsight. Every year we wait is another year of accruing more assets and accruing more fixed income sources and accruing more of a safety net to retire. But then every year is also going to be one less year that we're alive. Should David retire right now at 47? Should he wait till 50? Should he wait till 52? Or will we eventually find out that actually retiring back at age 45 was the right answer for David? So here's what I'd do if I were David. I would start with a 20-year cash flow projection. That exercise, it estimates all the future money that you'll earn and all the future money that you'll spend over the next 20 years. It'll include your portfolio, deposits and withdrawals and annual growth. It'll have cash inflows, whether they're coming from your salary or your pension or Social Security. It'll have cash outflows, of course, lifestyle expenses, taxes, travel, college payments for your now 14-year-old child, home updates, whatever it may be. So it has all the puts and takes. And from that, you'll get a net cash flow, inflows minus outflows. Then you'll calculate your total portfolio value at the end of each year. And you'll be able to see your projected portfolio withdrawal rates over time. You can do this in a simple Excel spreadsheet, right? 20 columns, 1 column for each year, and each row represents a different inflow or outflow or portfolio balance in your life. And if I were David, I would make maybe 3 or 5 or 10 different versions of the spreadsheet, depending on how ambitious you want to be, where the only difference between each version of the spreadsheet is going to be the retirement date or retirement age, which logistically really means you'll be changing things like what year will your salary inflow go to 0? What year will that particular row go from your current salary down to 0? In lockstep with that, in what year will your pension inflow start? And also, because we're varying the retirement age, how big will that pension inflow actually be? Usually they grow the longer you wait. What year will you start withdrawing from your portfolio? And how big will those withdrawals need to be in order to fully fund your lifestyle? Each iteration of that spreadsheet will lead to different portfolio sizes and different withdrawal rates. And you'll see that certain iterations, maybe if you pull the trigger today, David, you might see years of 5%, 6%, 7% withdrawal rates. But then another iteration, if you wait 5 years from now or 10 years from now to retire, You might see most of your years have a 3% or a 3.5% or a 2.5% lower withdrawal rates. You're creating this range of potential outcomes for yourself. And if you choose to do deeper analysis, say like a Monte Carlo retirement projection, those cash flow analyses will help inform where you should spend your time inside the Monte Carlo. For example, what I mean is if one of your cash flow spreadsheets shows you withdrawing 2% of your assets per year throughout most of retirement, I wouldn't waste your time to do a Monte Carlo analysis. You pretty much know in that particular scenario, you're going to be fine. Your withdrawal rate of 2% is so low compared to the conservative 4% rule. It's already conservative, and 2% is so much lower than that. Why waste your time doing a Monte Carlo analysis? Whereas if you really do want to retire at age 50 and the cash flow spreadsheet shows you withdrawing 4.5% of your assets per year, I would encourage you to run that scenario through a Monte Carlo analysis to see what your worst case retirement scenarios might look like. More than anything else, I see Monte Carlo analyses not as a how likely is your retirement to fail analysis, but instead, how likely will you have to be flexible in retirement analysis? How likely will you have to tighten the belt during down years in the market? How likely will you have to postpone the big trip because of a bad market? Those kind of things. That's really helpful to understand, and a Monte Carlo analysis helps provide some color to that type of question. Now, as far as specific advice about leveraging your inheritance, David, here's my 2 cents. I'm sorry your mom passed away, and I'd ask you if you feel any particular emotional connection to the money that she left behind for you. Now, if I'm just being this callous robot, I would tell you all money is fungible. From a strict planning perspective, treat this money as if you had just gotten $1 million bonus at work. It's money that can be applied to your goals and your timelines. It should be invested through the same exact framework as we'd invest any other money in your family's financial ecosystem. But because we are all human, I understand that this money might have some strings attached to it, either explicitly because of something your mom told you or simply because of something you feel inside. In that case, I would encourage you to find a balance. Make sure that you are honoring your mom's wishes, make sure that you're feeling good about however you're spending this $1 million or however you're allocating, earmarking this $1 million, but also try to take prudent steps toward advancing your and your family's financial plan. So thank you, David. I thought that was a great question. And next, on to question 3 from Karen. Speaking of risk and risk capacity, risk tolerance, those kind of things, Karen says, one subject I'd be interested in is the subject of risk capacity. I hear financial podcasts talk all the time about risk tolerance, which is how much you can stomach the swings in the market without panicking and going to cash. They also talk about risk capacity, how much risk you can afford to take without blowing up your retirement. But I don't think I have a good handle on how to figure out what your risk capacity is. So excellent question, Karen. The way you're defining these terms in your question, you're differentiating between the subjective feeling of risk and losing money versus the objective math of recovering from losing money. One thing I will say that is, admittedly confusing is a lot of these terms get interchanged all the time. Risk capacity, risk tolerance, risk deference, whatever it might be. And so it can get confusing because you can say, well, don't those all kind of sort of mean the same thing? The words that I've started using over time that I've found to be really helpful are willingness, ability, and need. So I might use the word willingness to describe the first part of your question, Karen. Someone's willingness to take risk has to do with their mental fortitude, and it's a subjective understanding of downside risk. Willingness is subjective. Where I would use the word ability to describe the second part of your question, Karen. An investor's ability to take risk is based on their capacity to withstand or recover from losses, either temporary or permanent. In general, the more assets you have, the greater your capacity to recover from losses, right? So more assets equals more ability to take risk. And that's why certain high-risk, concentrated, illiquid assets, illiquid investments, they're only appropriate for investors with excess capital, with a lot of money. Those investors are the only ones with the ability to take on that illiquid, high concentrated risk. But also for younger or newer investors, the ability to take on risk is directly proportional to their income and their savings rates. They have long timelines in front of them. They're younger investors. They're dollar cost averaging into their portfolios most likely. So even when investments are performing poorly, they're most likely buying in, right? Buying more as the market's dropped. So they have decades to make up for any losses. I would argue that that investor, that younger or newer investor, they also have a high ability for risk. Ability is about recovering from loss, either through excess current assets or through a healthy stream of future saving. So here's a soft example for you, Karen. I'm 35 years old as I talk into this microphone, and let's say we're about to kick off another lost decade in the US stock market. Just like the stock market had a lost decade from 2000 to 2010. A crash, or maybe two crashes, some decent recovery, but essentially a 10-year period without any true growth from the market. Now, my current assets on my balance sheet will suffer some losses and some gains during that period. Technically will be no worse for it, but also won't grow at all. But also during that 10-year period, my plan would be to continue to dollar cost averaging into my various investment accounts. I'll keep buying, including during the crashes, which will certainly be to my advantage in the long run. And by the time I do start tapping into all these assets, which might be at age 50 or 55 or 60, I believe all my assets will have had time to recover and grow beyond this hypothetical lost decade that I'm proposing. In other words, my 15, 20, 25-year timeline and also my desire to buy more investments over the coming years means that my ability to take on risk is quite high. But let me compare that or contrast that to a 57-year-old with aspirations to retire at age 60 in 3 years. Now, imagine if that person went through a lost decade of lows and minimal highs. What's different between them and me? Well, first, their current assets might suffer losses that also happen to coincide with their desire to withdraw money from their accounts. This is exposure to the so-called sequence of returns risk that we've discussed on this podcast in detail before. And second, for this hypothetical 57-year-old, they will not be dollar cost averaging into their accounts throughout this whole period of time over the next 10 years. They won't be buying assets while low. They don't get any of that long-term benefit from the lost decade period like I'm going to get. But it is worth asking, I've just kind of outlined a bit of a pessimistic lens. Should we apply that pessimistic lens to all of their portfolio, to all of their assets, or just to some? And this is where the goals-based investing, time and timelines, asset liability matching frameworks, that's where they all come into play. All various ways of saying the similar thing. I would argue that this 57-year-old has a significant portfolio of investment assets that they plan to withdraw over multiple decades of their retirement. Now, some of those assets are going to be withdrawn in the next 5 and 10 years, precisely coinciding with my hypothetical lost decade. But other assets of theirs will be withdrawn in 15 years or 20 years or 25 years, maybe even more. And that part of their portfolio, those assets, will be able to ride out and eventually recover from the lost decade, participating in whatever growth might occur on the far side of that event. So that person, this hypothetical 57-year-old, their ability to take risk is less than mine. It's much less than mine, but it's also not zero. For a portion of their assets, little to zero risk should be taken. But for another portion of their assets, plenty of risk can be taken. They do have some ability to take risk. Not as much as me, but some. And that might beg a question, kind of an interesting thought experiment. Are there people with zero ability to take risk? I would say yes, and it's not something I would wish upon any of you listening right now. Here's a hypothetical. Imagine an 85-year-old retiree. They need $30,000 a year to live off of on top of their Social Security payments. And between their bank account and their IRA, they have $150,000 in assets, or approximately 5 years worth of annual spending. They're in a bit of a pickle. They have no real ability to take on any risk. Now, what's interesting in kind of a morbid curiosity way is that they're between this rock and a hard place. If they take no risk at all, they're essentially guaranteeing they will run out of money at age 90. Whereas if they take some risk, or maybe even a ton of risk, they would now run the risk of running out of money at age 88 or age 89, but yet they also open the possibility of their money lasting some extra years to 90 or 91. And then you mix in the uncertainty of when they'll actually pass away, right? If they pass away next year, this whole conversation is a moot point. If they end up living till 95, there's probably nothing that anyone can do to prevent the inevitable that they'll run out of money. But the point is that this person, it's almost like game theory. It's like, do you take the giant bet because it's the only way to get out of your situation? Or do you take no bet at all because you really can't afford to lose any of that money? I would argue they can't afford to lose any of that money and they have no ability to take on risk. So Karen, your ability to take risk, recover from losses, it has to do with your age. Sure, it has to do with your timelines, yes. But it also has to do with if you're actively contributing to your accounts. I also might add that if you're accelerating more and more money into your accounts over time, if you're a younger professional with kind of a high earning potential in front of you, and you plan on not only putting in more money, but accelerating the rate at which you're putting in money, that adds even more ability to take on risk. I think that is something that many mid and late career professionals do find themselves in. earning more than ever, making catch-up contributions to their IRAs, 401ks. Maybe the kids are out of the house, college payments are done, and you've got this extra money on hand to dump into the market, to dump into your investments. So that's another interesting wrinkle when it comes to the ability to take on risk.
Here's a quick ad, and then we'll get back to the show.
You probably know that I love listener-inspired content, but this is my first listener-inspired advertisement. Frank asked me, in short, Jesse, is there a best time to start working with you as a client? And the short answer is yes. There are two ideal times. One is at the beginning of a new year for probably some pretty obvious reasons, but the second one is right about now, September and October. It's the perfect time for year-end tax planning to ensure you find the correct balance of Roth conversions, tax gain or tax loss harvesting, making charitable gifts, spreading out any portfolio changes over multiple tax years, or whatever other tax dials we can turn for you. Working backward from the December 31st tax deadline, the time to start those initial conversations is right now, August, September, maybe into early October. You want to give yourself and us enough runway to make sure we get this right for you. So if you're interested in starting a conversation with me and my colleagues, you can go to bestinterest.blog/work and fill out the form there. Again, that's on my blog on the Work with Jesse page. The address is bestinterest.blog/work and fill out the form. And now on to question 4 from James. James says, thanks for all the amazing content. I discovered your podcast in the last year and have become an enthusiastic regular listener. I'm cautiously optimistic that I'm on track to look very much like your Winning the Game article, and I'll link that in the show notes so you know what we're talking about, as long as the market doesn't throw any crazy curveballs at us in the next few years. My question is that after we all watched our bond funds take a beating during the last downturn, and that's 2022, we'll get into that with some of the interest rate chaos that happened then. James says, I'm rattled with that being my safety money. What are your thoughts? Are you recommending more individual bonds for the fixed income portion of portfolios? So James, thanks very much for reaching out. Congrats on almost winning the game, as it were. Phenomenal and common question about bond funds versus individual bonds, especially for someone gliding into retirement. So let me see if I can explain this succinctly. We need to start with the term duration. Duration is a term used in the bond world, in the fixed income world. And duration, just the word itself, right, in the dictionary implies time in some way, implies a length of time. And duration in the bond world is partly related to the maturity date or the term of a bond, a 1 year, a 5 year, a 10-year bond. But it also takes some other things into account. And in short, the duration of a bond is a measure of that bond's sensitivity to interest rate changes. Again, duration is a measure of a bond's sensitivity to interest rate changes. So a low duration bond is not very sensitive to interest rate changes. A high duration bond, though, is very sensitive to interest rate changes. And hopefully that idea makes a little bit of sense. Now, why? So let's imagine a 1-year bond that yields 5%, a 1-year treasury that yields 5%. Then we can compare that to a 10-year treasury that's also yielding 5%. Now, if we look at the 1-year bond over that 1 year, I would expect to put in $1,000 today, and a year from now, I'm going to get $1,050 back. So of the $1,050 that I eventually get back, about 5% of that eventual return of capital, about 5% of it is going to be a function of interest and interest rates. But if I look at the 10-year bond, the math is going to be importantly different. I would expect to put in $1,000, and then over the 10 years, I'm going to get $1,500 back. In the first bond, I got $1,050 back over 1 year, but in the second bond, I'm going to get $1,500 back over 10 years. So if I look at that $1,500 I'm getting back, $500 of that is interest. So 33%, a full third of that eventual return of capital is a function of interest and interest rates. So we can clearly see that the total return of the 10-year bond is more reliant on interest and interest rates than the return of the 1-year bond. For that reason, it should make sense that the 10-year bond is more sensitive to changes in interest rates. So now with that out of the way, we can pivot. And one thing I did to help James in a little email I wrote to him, I listed out 4 common reasonable Vanguard bond funds to him. Maybe some of you have heard of them. BND is the total bond market index fund, BND. And then BLV, a long-term fund, BSV, a short-term fund. So L for long, S for short, BLV, BSV. And then the ultra-short bond fund, VUSB, US for ultra short. What I did is I listed out the duration for these 6 funds. So BND, the total bond market index fund, has a duration of about 6 on it. The long-term fund, 13. The short-term fund, about 2.5. And the ultra-short fund, about 1. So if interest rates went up by 1% tomorrow, I would expect in pretty close approximation that the following would happen. BND would lose about 6% of its value because its duration is 6. BLV would lose about 13% of its value. The short-term fund, BSV, would go down about 2.5%. And the ultra-short fund would go down about 1%. And that occurs for very similar reasons as I described before. For the long-term fund, BLV, a very large amount of the future expected return of that fund is coming from interest payments. And for the ultra-short, the USB, for the ultra-short fund, a very small amount of the future expected return for that fund is coming from interest payments. To finish that logic, to take it one little step further, the point is that if I'm owning a bond or if I own a bond fund that is paying me out, say, 4% per year, and then tomorrow interest rates go up 1%, so now all the new bonds are paying 5%. Here I am over here, I own a bucket of bonds that are paying 4%, and now all the new ones are paying 5%. Who wants my 4% bonds if they could go out to the Fed and buy new ones at 5%? So what's essentially happened is that my bonds have lost value because their printed interest rate is lower than what all the new bonds are selling for. And that's why when interest rates go up on a kind of a grand economic scale, when the interest rates go up, the price of currently owned bonds goes down. Now, going back to the bond funds versus individual bonds, owning individual bonds doesn't really fix this issue. Owning individual one-year treasuries would be very similar to owning that ultra-short bond fund that I just described, and you would see very similar interest rate sensitivity. Owning 10-year treasuries would be very similar to owning a 50-50 mix of BND, which was the 6-year, the duration of 6, and BLV, which had the duration of 13. So if I kind of own a 50-50 mix of that, I'm going to have a similar interest rate sensitivity to owning 10-year treasuries. There's no benefit to owning individual bonds in this case. And I've read here on the podcast before, there's a pretty funny teardown of this idea from investor and kind of infamous crank Cliff Asness, who basically says, if you open up the hood of a bond fund, all that's in there are a bunch of individual bonds. And so the idea that you could somehow own those individual bonds and get something better or get something different than the behavior of the bond fund itself doesn't really make sense, right? It's like saying, instead of having a shopping cart of food, I'm just going to go out and buy bananas and buy beans and buy crackers. And you look in the shopping cart and what's in there, it's bananas and beans and crackers. It's just the same thing. So what's an actual recommendation? Instead of all this esoteric definitions that I've been giving you, what's my actual recommendation to someone who's facing this problem, who's maybe looking down the barrel of retirement, trying to figure out what they should do for their bond allocation? I would build my retirement portfolio such that the money I need in year one of retirement is probably going to be in some sort of ultra short bond fund with a 1-year duration. And the money I need in years, say 2 through 4 of retirement might be in a short-term bond fund with 2 to 4 years of duration. And then once you get out to say years 4, 5, and 6, depending on your ability and willingness to take on risk that we were talking about before, that's where maybe some of those intermediate years, maybe some of that money is going to own something like BND, which was had that 6-year duration on it. But also, maybe that's where you start sprinkling in some stocks. And then for years 8, 9, 10, and beyond, if you're pretty low on the risk spectrum, maybe you still have some fixed income in there for diversification. But also, largely, that money for years 10 plus is going to be invested in just greater risk, greater reward assets like stocks. So you're building this portfolio from the bottom up. And that way, if 2022 were to happen again, and again in 2022, interest rates shot up essentially faster than ever before in history. I've got some data in a minute here where I talk about the way that some funds still haven't recovered. Some bond funds still haven't recovered from 2022. But if 2022 were to happen again, in the solution I just described, my short duration bond monies would be very, very minimally affected, right? The money I need this year and next year and the year after that would be very minimally effective. Now, if I owned some longer duration bonds, they would have at least more time to recover they'd have more time for interest rates to come back down and the actual value of the fund to go up. And or I would also own stocks in some of those same buckets, for lack of a better term, for some of those same timelines to help diversify over that recovery period. In other words, the problem that's occurring very often behind the scenes when these type of questions come up is that someone owns, for example, they own a bond fund with a long duration in order to cover their near-term expenses. They probably don't realize it, but the way they're covering their near-term expenses is by owning a long-duration bond fund. BND, for example, is a very popular choice in the bond world because it's an index fund that represents ownership of the entire US bond market. But BND currently has a duration of 6 years. BND lost 17% of its value in 2022, as much as that at one point. That was peak to trough, 17% down when those interest rates spiked as part of kind of the COVID stimulus recovery. And even including all of the income that the fund that BND has produced since then, BND is still down 4% from its 2021 highs. Now, if all you look at is price alone, BND actually looks like it's down 13% from 2021. And that right there, as a little aside, is why looking at bond price is simply not good enough. So here's a quick little lesson, a quick little aside for you DIY investors out there. Don't only look at a bond or a bond fund's price. It's not good enough, especially over longer periods of time. The price of a bond or the price of a bond fund does not account for the interest payments that that bond or bond fund has been paying along the way. For example, in 2023, if all you looked at was BND's price, you would see that it was up 2.3%, but its total return to investors was actually 5.7%. So that difference between 2.3 and 5.7, that 3.4% difference, that was the interest payment that BND paid out back to investors. So I know a minute ago I discussed why holding a bond fund is no different than holding individual bonds, but just to drive the point home, it can be true, and some people might say, well, if I hold my individual bonds to maturity, I'll always get my money back. And I don't know if I get that same thing from a bond fund. But if a bond fund is also holding its bonds to maturity, then you'll always get your money back there too. The math is exactly the same. And for that reason, it can be worth understanding if any bond funds that we're invested in, that you're invested in, you can ask yourself, you can look at the bond fund itself and try to understand, is it being passively managed or is it being actively managed? Now, an actively managed bond fund might actually choose to sell bonds before their maturity date. And perhaps they're doing so for smart reasons, and that'll actually increase your return from the fund. Or perhaps the active manager does so for poor reasons, decreasing your return from that fund. And that's true for any type of active management. Whereas a passively managed bond fund is very likely to hold all their bonds to maturity, ensuring the underlying investors are receiving exactly the promised nominal return that they signed up for in the first place when originally investing. So, very interesting question. I hope that helps understand not only the mechanical differences between individual bonds and bond funds, but also that little definition about duration and why those ideas are so important when it comes to retirement planning, when it comes to the timelines kind of inherent in our retirement, and why just because you own a diversified bond fund doesn't necessarily mean that you are properly planning for your early years of retirement. And now on to question 5, which came from listener AC. And AC said, increasing income is easier said than done. A podcast episode on the importance of increasing your income and how to do it would be helpful. You work with high net worth clients, Jesse. I'd speculate that they have advice on how to increase your income. Yeah, so AC, the topic of savings rates, increased earnings, decreased spending, a very common topic here in the personal finance world. My party line is that for any of us, it's almost always going to be easier in the short run, an emphasis on the short run, is going to be easier in the short run to decrease your spending. If that's the way that you want to increase your savings rate, in the short run, you should focus on what you're spending and what you can control kind of easily that way. However, if you're out there and maybe your little nephew is just discovering personal finance for the first time and he's trying to figure out what he can do in the next month to improve his lot in life, to improve his personal finances, the answer is going to be for him to start monitoring his spending and ultimately decreasing his spending. But over the kind of the mid to the long run, as AC alluded to in the question, we are far better off focusing on ways to increase our income. It's just that they're not easy. If it was super easy to increase your income, then everyone would be doing it. It's kind of like that Kurt Vonnegut quote from Slaughterhouse-Five that, Americans, like human beings everywhere, believe many things that are obviously untrue. Their most destructive untruth is that it's very easy for any American to make money. It's a longer quote and worth looking up if you're not familiar with it. But the fact of the matter is that it's hard to find ways to increase your income, or at the very least, it takes time, it takes effort, it takes maybe some focused work. So what are some tips, and that's what I'll spend kind of the rest of this answer talking about, are some tips that we can actually use to increase our income. The first one that I found personally successful and seen a lot of stories about is to simply talk to your manager or your boss, assuming you work for a manager or a boss, that is, assuming you aren't self-employed. The more time that I've spent working here in America, both at a really big corporation in my old aerospace engineering job and now at a much smaller company here in my wealth management job, the more I realize how much a good manager will value a good employee. So if you think you're a good employee and you have a good manager, I think you should go ask them what you can do to earn more money. They might not be able to snap their fingers like a genie and just make it appear for you, but they'll help you put a plan together to get you there. Granted, I know there are many jobs, especially probably like public sector jobs, where it's simply not possible. They're going to pay you based on your experience level, the number of years you've worked there, and that's it. My parents were both school teachers. They couldn't just go to their manager, their boss, and say, I want more money. I get it. But if you do work at a job where that's possible, I 100% encourage you to go talk to your manager or your boss about putting you on some sort of plan to eventually get the raise you've been looking for. That being said, my second tip, again, especially in corporate America, is to change jobs or change employers. Job hopping, for better or worse, often yields the fastest salary bumps. One of my most popular blog posts I've ever written, and I'll link it in the show notes, tells the story of my negotiations at my old aerospace engineering firm, where tip one, my first tip of talking to my manager or my boss, didn't work. Now, my manager, she did lobby on my behalf. She was very helpful, but HR, human resources, shot down the idea of me getting some sort of raise, which to some extent forever turned me off to the human resources profession. No offense if you're listening as an HR professional right now. It's not personal. Get it? It's not personal because HR has to deliver bad news all the time and it's never personal. Anyway, eventually I did get the raise I was looking for because I had to spend, what I ended up doing was spending about 2 months and taking multiple trips around the country interviewing with a competitor firm. And they gave me a great offer to come work for them. And only then did my current firm match that offer and give me the raise that I was looking for. I find that whole game of, interviewing at other places just to get an offer and then taking that offer back to your current boss and saying, now will you pay me more? I find that game kind of lame. But the fact of the matter is it's a real part of corporate culture. And so if you're looking for a raise, I think if you're looking for more income, I think it's worth understanding how that game gets played. On to tip 3, professional certifications or licenses. So, here in my world, CFP, CFA, maybe CPA as an accountant. I know for project managers, the PMP certification, going to a coding boot camp, getting a trade license, something like that. The payback can be really big. But again, I would make sure you talk to your manager or your boss first and you try to get them to commit to some sort of quid pro quo. If you go out and get your PMP designation, then they'll give you a raise of X. Talk to your boss first, go get the certification, and go get paid more. Tip 4 is to think about growing something on your own. And this one is a little hairy, as I know plenty of people who have tried or who are trying to build a small side business or grow some sort of online XYZ business. Nothing seems to be happening for them. When I look back at this very project that you're listening to right now, for 3 or 4 years, I wrote and then started the podcast for no real business reason. I wasn't earning any income. I wasn't really looking to run a business per se. It was just some side hobby that didn't really have any sort of business intent. But then I think of one of my neighbors, like in my neighborhood, he's got a great 9-to-5, but then on the side, he runs a knife sharpening business out of his garage. It's just a terrific, small niche business that he can do on nights and weekends. My brother dipped his toe into entrepreneurial waters first by doing handyman work for like $75 an hour when he wasn't working his 9-to-5. And eventually he realized he could cobble together enough of those handyman engagements to make it his full-time job. And then he shifted to only saying yes to the bigger jobs, the 4-hour jobs, the full day jobs. And now he's doing full-on kitchen remodels, bathroom remodels, basement remodels. It's taken him 5 years, but it's made a massive impact in his life and in his lifestyle to go from the 9-to-5 job where he wasn't getting paid enough and didn't really enjoy it to now literally running his own business and only taking big jobs and getting paid a much fairer wage for it. So that's tip 4, trying to grow something on your own. Tip 5, thinking more long-term now, and this we're transitioning as these tips go on into slightly more long-term thinking. Tip 5 is to climb the career ladder in some sort of strategic way, because climbing that career ladder, it isn't just about working hard, it's also about working smart. Thinking about, clarifying where you want to go. Where do you see yourself in leadership, in management? Do you see yourself becoming a technical expert or maybe pivoting into a new role entirely or a new division, a different division in the company that you're at? Because once you know that destination of where you want to end up, a great way of doing that is by looking at the current leaders and figuring out which one of them you most want to emulate. But once you know that destination, then you can map out the skills or the relationships or the experiences you'll need to get there. Networking, for better or worse, it's just as important as performance and technical skills. Building strong relationships with your mentors, with your managers, with colleagues, the people who could advocate for you maybe when an opportunity arises, and then having to track your accomplishments as time goes on, to connect them to measurable outcomes that impact the bottom line of the company. There's something there where managers promote that kind of impact, not just the effort that you put in, but really the impact that you make to the bottom line. And then the last tip here would be to stay adaptable. Careers rarely follow a straight line, but if you're intentional about positioning yourself for that next step, promotions and raises often follow on quite naturally. Again, thinking long-term here, onto tip 6 is to develop high-value expertise. The marketplace rewards skills, and not any skills, but skills that are rare, that are difficult to replicate, and that are in high demand. It ultimately comes down to supply and demand. And so developing one of those high-value expertise skills is one of the surest ways to grow your long-term income. That's why specialist physicians, attorneys, senior engineers, C-suite leaders can command such strong salaries. Getting there obviously isn't quick. It often requires years of education, credentialing, apprenticeship, something like that. For example, one of the highest earning people I personally know fits into that description of a specialist physician. Because of the way medical school and specialization works, he didn't start earning big money until his mid to late 30s. Now he's approaching 50, and he's more than making up for that. But I think one of the keys there is to view the extra time and the extra training. In his example, most of us started earning a real paycheck at 22 or 24. He really didn't start earning a quote unquote real paycheck until 35 or 37. He put in 12 extra years of extra training time. And I think it's important to view that as an investment, right? Each exam passed, each certification earned, each project completed adds to your career equity, we could call it. And over time, you become not just another professional, but the go-to expert. And that status carries weight, which includes higher pay, more job security, and greater influence. But the opposite side of the coin is that that particular path also demands persistence. The work can be grueling, progress isn't always obvious, but sticking with it, that high-value expertise creates leverage that lasts for the rest of your career. And it's that slow burn of career growth that can be hard to start, but it really does compound and becomes very powerful once the ball gets rolling. And then my last tip on this one, tip 7, is equity participation. Equity is when you earn more than just a paycheck, you gain ownership in the underlying company, the underlying venture. So instead of trading your hours solely for salary, you're tying part of your income to the growth of the business itself. And that might come through stock options or restricted stock units, RSUs, some sort of profit sharing agreement, or directly buying into the company. The upside, of course, is that if the company grows, if the business grows, your equity can multiply in value far faster than a steady raise ever could. But the equity isn't necessarily free money, right? It carries a lot of risk. Shares can lose value. Options can expire worthless. Private business ownership can be illiquid and uncertain. I mean, the business can go out of business, and that part of your balance sheet goes to zero. But still, equity is how wealth is often built at scale. It transforms you from a simple employee into a partial owner, and that aligns your personal financial success with the company's financial success. And for ambitious professionals, that is a game changer worth pursuing. So AC, thank you very much for the question. Those are some of my thoughts on how people can practically and logically focus on increasing their income over time.
Here's a quick ad, and then we'll get back to the show.
I love getting your questions, and some of you ask me questions about the wealth management firm I work for in Rochester, New York. Others ask about the Best Interest blog and this podcast, Personal Finance for Long-Term Investors, which operate without advertising, without pushy sales, and with no paywalls. How can the blog and podcast stay afloat without me dumping my own money into it? Well, to answer both those questions, I want to point you to episode 78 of Personal Finance for Long-Term Investors. I intentionally recorded episode 78 to shine light on those topics and inform you how you are actually helping and can continue helping these projects carry forward. So if you've ever been curious about the business of my blog and podcast, or if you're curious about my day job in wealth management, please check out episode 78 and let me know what you think. Okay, and now on to question 6. This one's from Justin, and this one's a two-parter. It's probably gonna be a long two-parter, so I'm gonna tackle part 1 here today in this episode. If you're hungry for more, please reach out to me, and I'll probably then tackle part 2 in a future episode. But at the same time, if this is something that you say to yourself, you know what, I don't really care about this topic, do me a favor and skip part 2. I'll listen to you on that front too. So the question is quite simple. Jesse, can you explain cryptocurrency and stable coins? I'll tackle cryptocurrency today from a very high level. I'll tackle stablecoins potentially in a future AMA episode if you guys find it interesting. And I want to address this question not because I believe in cryptocurrency necessarily, but instead because the total market cap of the cryptocurrency world right now is about $4.4 trillion. So if crypto as a whole was, say, a company, it would be the biggest company in the world. Bigger than Nvidia, bigger than Apple, bigger than Microsoft, etc. And I think this conversation is kind of like having an important talk about drinking and drugs with your kids. You might inform them that at college, they're going to see drinking, they're going to see some weed. I remember walking to a bathroom at Psi U fraternity my sophomore year where there was some sort of party going on. And one of the guys from the band that was playing downstairs, he was doing cocaine on the sink. Now, that wasn't exactly my type of partying, but I knew what it was, and I knew why, personally, I had no desire to partake. And pretending like it didn't exist wasn't really the right answer, at least to me. Like, it's there, and it's probably better to know about it and then to choose not to do it than to not even know what it is in the first place. So it's a funny analogy, but similarly, I don't think anyone needs cryptocurrency in their portfolio. No one needs to own it, but it is out there, and it's really big. And it doesn't really seem to be going anywhere. So for that reason, I do think it's worth at least understanding what it is, how it works, why some people see value in it, and why other people think it's, snake oil. So let's dive into that conversation. And specifically, I'm going to read from a pretty long article I wrote back in 2021 explaining Bitcoin in simple terms. Now, I know that Bitcoin is only one cryptocurrency and that other cryptocurrencies have a different quote unquote protocol. But I do think that trying to explain this one clearly and simply will at least open your eyes to, how the greater cryptocurrency world works. So without further ado, let's go first into the highlights. Very highlights, a high-level review explaining Bitcoin in simple terms. Everything that I'm about to say over the next, call it 2 minutes, will be explained deeper and further as it goes on. Bitcoin is software, for lack of a better term. It's software that tracks a digital-only currency. There's no physical currency. There's no coin that you can hold in your hand, like you can hold $1 or a quarter. Individuals, people like you and me, we use what's called a digital wallet to quote-unquote store your Bitcoin. Those wallets, they have a unique Bitcoin address that makes them unique to you. And they are very secure. They are very private. They can only be accessed via a unique password, just like logging into any other account with a unique password. In the cryptocurrency world, that password is called a key, like the key to a door. So using their private key, their private password, an individual can authorize a transfer of Bitcoin from their wallet, from their private account, to another person's private account. Now, every transaction that's ever occurred like that, any transaction from wallet A to wallet B for any wallet in existence, every transaction that's ever occurred is recorded on this thing called the blockchain. The blockchain, technically, it's called a distributed ledger. I recommend we think of it just like a spreadsheet. It's a spreadsheet. That's all that the blockchain is. And every row on that spreadsheet says, wallet A just moved money to wallet B, and the amount of money that was moved is X. The amount of Bitcoin that was moved is X. That's all it says. This wallet moved this much Bitcoin to that wallet. That's what each entry on the spreadsheet on the blockchain says. Now that blockchain, that spreadsheet, is maintained and monitored. Think of it maybe as a Google sheet with a bunch of different people having access to that Google sheet. And people all over the world are monitoring that spreadsheet at all time. Those people monitoring it, they're called nodes. And the nodes record new entries on the blockchain and then validate new entries that are added to the blockchain. When new transactions occur, those have to get validated. So again, what exactly does that mean? We will talk about all this in more detail. New transactions are bundled into these things called blocks, and then a block is added to the end of the blockchain. In order to provide validity to new blocks, and I know, I can hear myself saying these words, and I know you might not be following me, but I'll forge on. In order to provide validity to the new blocks, in order to confirm that all the transactions there in the new blocks are real, are legitimate, something called proof of work must be submitted. And that proof of work, I'll just tell you, it solves a difficult cryptographic puzzle. And that puzzle solving process is called mining. And the first node, the first miner to solve that puzzle that validates the new transactions is actually rewarded with Bitcoin as their prize. Thank you for solving this puzzle. Thank you for validating these transactions. Here's a little bit of Bitcoin to reward you for that work. The puzzle itself involves this specific type of cryptographic puzzle. It's called an input-output code or a hash. And the hash only works in one direction. So you can easily verify that a specific input to the puzzle led to a specific output, but it's essentially impossible to start with the output and then find the input. The challenge in the puzzle, the challenge that the miners are given, is that they're given an output and then they have to guess and check their way to finding the correct input for that puzzle. The puzzle itself, you can't really predict that puzzle ahead of time because it's based on all of the previous blocks, so that the next puzzle is only created once the previous block has been added to the blockchain. So that's why you can't predict or solve a puzzle ahead of time. All the miners on planet Earth are competing to solve this puzzle. Only one miner actually wins. That miner provides their solution or proof of work to the puzzle. All the other nodes on the network, all the other nodes in the world verify that the proposed solution is mathematically correct, and then that new block is added onto the blockchain, verifying all the transactions therein, and the winning miner gets a prize. And then the process starts all over again for the next block. So that's it. That's explaining Bitcoin in simple terms. So far we might be, 5 minutes into this explanation, and personally, I wouldn't blame any of you for saying that, Jesse, what you just said doesn't really describe anything to me. And I get it. So stick with me, trust me on this. In order to understand how Bitcoin works, we actually first need to understand how traditional money works. Once we agree on the basics of traditional money, then explaining Bitcoin becomes much easier. Money is all about trust. It's based entirely on a network of trust. There's no intrinsic reason why a little green sheet of paper with a former president on it can be traded for a week's worth of food or for new shoes, or I can take a stack of these little green papers and trade them for a car, right? The grocer, they accept that little green paper because he trusts it. He can use it to pay for his store's expenses. The store employees accept their salary in green papers because they trust that the papers will pay for their lifestyle. It's all about trust. And you might say, well, doesn't the government back up their money with gold? Yes, the US monetary system was once backed up by gold, meaning that you could go in at any time and trade your green little dollars for a nugget of gold. But that ended in 1933 when FDR allowed the US Treasury to print money without an equivalent gold backing. And that fiscal stimulus got us out of the Great Depression. And then in 1971, Richard Nixon completely severed ties with the gold standard by no longer permitting foreign countries to exchange US dollars for gold. Since 1971, when Nixon did that, only trust has supported the US monetary system. So let's dig into that trust network a little bit deeper. Why do we need money in the first place? I think it's important to imagine a world without money. A carpenter goes to the grocery store to buy food. Without money, how does the carpenter pay? Well, he can trade his skills. But what if the grocer doesn't need any woodwork done? So instead, the carpenter would leave behind some sort of IOU, a favor to be repaid later. The shoemaker, they have a leaky roof. The shoemaker hires the carpenter to come by, and they agree that the carpenter's fix-up is worth 20 pairs of shoes. But the carpenter doesn't need 20 pairs of shoes, so the shoemaker agrees that he'll owe the carpenter in the future. So we have another IOU. And the grocer is on his feet all day, and he's worn through his shoes. He goes to the shoemaker to buy new ones, but the shoemaker's garden is in full bloom, and he doesn't want to trade shoes for food, at least not right now. So how does the grocer pay for new shoes? With an IOU. It's a simple example. The carpenter owes the grocer owes the shoemaker owes the carpenter. We could expand this example further to represent the entire world's economy, where businessmen owe airlines, and the airlines owe the fuel company, and the fuel company owes the oil drillers, and a complicated web of IOUs would ensue. And how would we ever reconcile all these different IOUs? It's an accounting nightmare, with each individual tracking their credits and their debits. But universal trust in money completely solves this problem. We convert each IOU to a dollar amount, and each person measures their debts and their credits in dollars rather than in unique products like berries and fish. The markets, supply and demand, will determine where prices will eventually settle, and the economic activity would flourish because concerns over payments would basically disappear. That is why we need money. But at least right now, who is in charge of money? Well, in the US, we have two institutions with the greatest monetary responsibility, the Federal Reserve and the Department of Treasury. The Federal Reserve is part of the government, but operates with some autonomy, at least for now. It's the country's largest bank. The Fed has three main mechanisms that it can use to manipulate the amount of money circulating in the economy. It can buy or sell Treasury securities, thus adding or subtracting money from the economy. It can adjust interest rates, just like it did throughout the COVID-19 pandemic and recovery. And last, the Fed can change requirements on how much money a bank has to keep in reserve. This is called the reserve requirement. One of the terms often associated with the Federal Reserve is quantitative easing, or QE. And that describes the process where the Fed buys securities, treasury bonds, or other assets using money that essentially the Fed creates out of thin air. So quantitative easing injects money into our economy, kind of helping grease the wheels during hard times. But this increased supply of money without increasing the demand for products will lead to inflation or the increase in prices of goods and services. Now, some people credit QE with saving the economy after the 2008 financial crisis or saving the economy during the COVID-19 pandemic. But many people are concerned that QE is leading to out-of-control inflation, that we will eventually have to reap what we have sown. And one of Bitcoin's and cryptocurrencies' ideal use cases takes inflationary power away from institutions like the Fed. I also mentioned the Department of Treasury before. The Treasury is in charge of printing money that the Federal Reserve requests. The Treasury distributes that money to the public and to banks. They sent, for example, the COVID stimulus checks. And the Treasury is also in charge of the IRS. They collect your taxes. Again, Bitcoin's ideal use case removes power from the Treasury. You can't just print more Bitcoin, and we'll explain why that is later. So the question, I suppose, that the cryptocurrency maximalists would say is, do we need Big Brother? Do we need the government in charge of our money? So as we start to transition this explanation into discussing cryptocurrency more deeply, one of the fundamental questions is, do we need the government in control of our money? Do we need banks to keep accounts organized and to charge us fees in the process? Can't the community just take care of these responsibilities all on their own? Since money is based on person-to-person trust, why do we need the government involved in the first place? And if free markets solve all problems, why do we need the government handcuffing our monetary freedom? Those are some of the questions that cryptocurrency purists will ask, and we'll keep them in mind as we proceed. So what makes some money good and other money bad? If we look it up, there are 8 unique attributes that economists or historians talk about when it comes to good versus bad money. The first one, general acceptability. This is the trust that we've been discussing. Money needs to be trusted and accepted universally. Number 2 is portability. Money needs to move, right? Dollar bills, they're light. Credit cards and bank account transactions and PayPal and Venmo can occur electronically. Gold, however, is fairly challenging for an individual to move. You literally need to be able to move or port your money from place to place. The third unique attribute of money is indestructibility. Now, imagine if money was made of tissue paper. You hand over a $50 bill to a cashier and it just rips in half. Who's at fault? That's a problem you want to avoid. The fourth attribute is homogeneity or fungibility. Money needs to be the same such that your $50 bill is identical to my $50 bill. After all, they have to be worth the same amount. This ability for one unit of money to perfectly replace another one is called fungibility. Money is fungible. Stocks and gold are also fungible. But baseball cards or pairs of shoes are not fungible because once used or once wrinkled or once made dirty, they have a different value than what a new copy would have. The fifth attribute is divisibility. We need to be able to take large amounts of money and break it down into smaller amounts. If I have a $100 bill and I need a candy bar, I need a choice other than buy 100 candy bars, right? You need to be able to make change for me. The sixth attribute is malleability. This applies to physical money mainly. You need to be able to work with the material. Paper, easy to print on. Silver and gold can be easily melted and stamped, and that's why they were so often used as coins. Glass would be tough to make money with. The seventh attribute is recognizability. You've got to be able to recognize money as money. Unique coins, unique bills, unique credit card designs. And then the last one, the eighth one, stability. And this one is huge. We need to rely on the fact that the cost of goods today is relatively stable to the cost of goods next week. So now that we've covered a bunch of basics about money in general, let's get back to explaining Bitcoin. Bitcoin, again, is a software. It tracks a digital-only currency. There's no physical currency. There's no coin you can hold in your hand. Bitcoin is decentralized. That means that there's no Federal Reserve. There's no Department of Treasury involved. There's no higher power that signifies trust or stability. Then you might ask, how can we trust Bitcoin? We'll get into that. The Bitcoin network was started in 2008 by a person, maybe a person, named Satoshi Nakamoto. Could be a real person, could be a fake name, could be a group of people using a fake name. We don't really know. And that mystery surely adds some intrigue to the story of Bitcoin. But Nakamoto's idea was to create a currency that could be trusted independently of government interaction and independently of personal trust. The algorithms and the codes used in the Bitcoin network, they're all open source. Anyone with a computer science background can look at them and learn how it works. There's full transparency. And the metaphor I'd like to use here is, why do you believe that the sun will rise tomorrow? And the answer is that the natural world of math and physics suggests that the sun will rise tomorrow. So Nakamoto, he wanted to use math, similarly, just the world of math, to create a similar level of intrinsic trust for Bitcoin. That brings us to the topic of wallets and ledgers and blockchains. So if you had Bitcoin, you would keep it using a wallet. The problem is that the name wallet kind of connotes this idea of storage. If Bitcoin is the thing, then the wallet stores the thing, but that's not really true. Instead, a wallet is nothing more than an identification number or an address and a set of passwords or keys. It's really similar to how your bank account ID would work. Your bank account is not a physical vault at the bank. It's just an ID and a password. And the bank's ledger, the bank's spreadsheet, uses that ID to track an account amount, right? To track the number of dollars in your account. That bank account is this intangible storage. Again, it's not a physical vault. It's really just a line on a spreadsheet that your bank keeps. Bitcoin wallets are very similar to that. They're password protected using one or more private keys, private passwords that you, the wallet owner, would have. Some wallets can be accessed online, say through like a Coinbase type website. And since they're online, they can easily communicate with the rest of the Bitcoin network. Other wallets, though, exist on local hardware, like on a personal computer or on a USB drive. They're more secure that way. They're much harder to access that way. And those kind of wallets require a little bit of extra work, like an internet connection, to then connect to the larger Bitcoin network. So the next question I want to tackle is, how does another person know how much money is in my Bitcoin wallet? And that's answered by the blockchain, also called the distributed ledger. And when you see that word blockchain or ledger, you should just think community spreadsheet. That's it. So for simplicity, just imagine that the blockchain is a giant shared Google sheet shared by thousands, if not millions of people all over planet Earth. That blockchain lists every single transaction that has ever occurred on the entire Bitcoin network, just like you might use a spreadsheet to list business payments or to operate a budget. So if Bob paid Frank 2 Bitcoins in 2016, and if Jim paid Sally 5 Bitcoins in 2018, on and on and on, all of those transactions are recorded on the blockchain. Every single wallet-to-wallet transaction that has ever occurred. So in that way, by tracking all of these transactions, we know exactly which wallets have Bitcoin in them and exactly how much Bitcoin is in each one of those wallets. However, what we don't know is which human being on Earth owns which wallet. So in that way, the system is what we call pseudonymous. We know where activity is occurring. We know which wallets have how much Bitcoin. We just don't necessarily know who as a person is associated with which wallet ID. Now, when I go to make a new transaction, as long as I do so and I include my correct private key, my password, then the network trusts that the true owner, me, because I'm the one who knows my own password, that I'm actually making that transaction and the network will approve my transaction. Now, in the current monetary system, banks and governments control those spreadsheets. The bank gives Jim permission to pay Sally. But why do we need that central authority intervention? The crypto community says we don't. The goal of cryptocurrency is to maintain this globally shared copy of the spreadsheet so that people like you and me can independently verify those transactions. And we'll get into more detail here. So each person on the network who's verifying those transactions, again, they're called a node. So now let's get into verification and mining and that whole crypto prefix, right? Why is it cryptocurrency? It might feel like we're close to having a complete system. So far, we've covered that Bitcoin is a virtual currency. There's this giant shared spreadsheet called the blockchain that tracks every single account or wallet. It tracks every single transaction, the quantities of those transactions. And if all the nodes agree on the state of the spreadsheet, then we're really happy. We know who has money, who has Bitcoin, and how much they have, and it's all fine. But what more do we need? What we need is trust. We need a way to validate the trustworthiness of the blockchain. Like, how do I really know that Brian has 5 Bitcoin in his wallet? What if someone else's copy of the blockchain, what if someone else's copy of the spreadsheet says Brian only has 3 Bitcoin? How do we all agree on a consistent, uniform version of the blockchain? The answer lies in cryptography and mining and proof of work. As a simple spreadsheet might be really easy to alter or easy to hack or easy to fake. So Bitcoin uses complicated cryptography or code solving to verify new transactions. The act of solving those codes is quote unquote mining. Bitcoin mining provides something called proof of work. We'll break all this down. Proof of work. So how do you trust your trainer at the gym? Well, is it because he's fat and unathletic? Or is it because he's muscular and knowledgeable? It's not a trick question. You probably trust your athletic trainer because his body and knowledge act as some sort of proof of work. He's put in the effort and he has the results to prove it. That makes him trustworthy. The same to some extent works for Bitcoin. Whenever we append some new transactions, aka a new block, to the community spreadsheet, those new transactions come with a very difficult puzzle and proof of work that the puzzle has been solved. All the other nodes in the network can see the solved puzzle and can test its proof of work for themselves. It's called consensus. The proof of work verifies that the new transactions are in harmony with the current iteration of the blockchain. All the nodes can see that the new transactions reconcile with the current state of the spreadsheet. It's a little bit like showing your work on your math test. It proves your authenticity to the teacher. You and I can easily determine a physically fit person. It's pretty obvious. We can also determine that you know what's on the math test. But how do all these nodes agree that a new block of transactions has been verified by a sufficiently laborious proof of work? How much proof do we need, and what exactly does that look like? So here's where the crypto bit comes in. The crypto prefix refers to cryptography, the act of breaking codes. And breaking a sufficiently difficult code, which I called a puzzle previously, acts as proof of work for the Bitcoin network. Like many codes, cryptocurrency codes are difficult to decipher upfront, yet easy to understand once you have the key, once you have the secret. Good cryptocurrency codes accomplish this via two distinct character traits, if you will. The first one is that these codes are typically one-way only. You can always and easily trace an input to an output, but you can never directly trace an output back to an input. And I know that's kind of confusing. It's kind of like a Play-Doh squeezer. If you've ever played with a child who has a Play-Doh squeezer, it's really easy to start with a random lump and squeeze out a very predictable pattern from the squeezer. But it's basically impossible to start with this pattern that came out of the Play-Doh and then accurately recreate the random lump. Was the starting Play-Doh, was it kind of lumpy or was it very lumpy? Did it look like a goose? Did it look like a cookie? We simply don't know. The squeezer, which in this case represents the crypto hash, creates an end pattern that simply cannot be traced back to its origin. It's only predictable in the one direction, not in the other direction. The end products might be slightly different from one another, a little more blue Play-Doh, a little more red Play-Doh, but they are vastly different from their respective input lumps. The second important trait of a good crypto code or crypto hash is that it's subject to what's called the avalanche effect, which some people would call chaos theory or the butterfly effect. In short, a tiny change in the input results in a massive change in the output. A little extra red Play-Doh in the starting lump might completely change the appearance of the output. In this article that I wrote, which we'll link in the show notes, I put in a real example of how a simple, small change completely changes the output from a crypto hash. The sentence, "the quick brown fox jumps over the lazy dog," versus that same exact sentence just with a period at the end. "The quick brown fox jumps over the lazy dog" with a period at the end. Those two different inputs result in vastly different outputs. And the puzzle in cryptocurrency, the puzzle in Bitcoin, is to start with an output and then have to go backwards and guess what input might have created that output. It's to start with the patterned Play-Doh at the end and then determine what the lumpy Play-Doh at the beginning looked like. How do we do that? We have to create a billion different lumps of Play-Doh, send them all through the Play-Doh squeezer, and then compare them to the target output that we were given. A perfect match solves the puzzle. It really is just a brute force game of guess and check. So how do we do that in the crypto world? How do we determine the quote-unquote target pattern of Play-Doh, and who does this solving? Mining is the act of solving these puzzles. It invokes images of physical labor and hidden discovery. But, a puzzle in the crypto world might be to discover an input that creates a particular output of X or less. So you're given this binary number, and you have to find an input value that goes into this hash, that goes into this code, to create an output value less than the one that you were given. And mining solves this process by simultaneously completing two tasks. First, the complexity of the puzzle provides sufficient proof of work to all the other Bitcoin nodes, verifying all the recent transactions. New blocks are assumed guilty until proven innocent. Because remember, these new blocks contain new transactions. Which wallets are sending money to which other wallets? And if you get that wrong and you add it onto the blockchain, you've kind of just blown up the entire system of trust. So the new blocks are assumed guilty, as if a random bad actor is attempting to add fraudulent transactions to the blockchain. So mining's proof of work does provide some sort of evidence of authenticity. And second, the miner who solves the puzzle earns Bitcoin as a reward. And those rewards have been decreasing over time by design. So approximately every 10 minutes, a puzzle is solved. A new block of transactions is added onto the blockchain. Importantly, the details of the current puzzle and the details of the current transactions are part of the inputs for the next puzzle. So in that way, the new puzzles are totally unpredictable. You can't solve a new puzzle ahead of time. The newest puzzle is based on the transactions that we won't know about until the current block is solved. And miners, they repeat their guesses and checks a million, a billion, a trillion times or more until the current puzzle is solved. The difficulty of the current puzzle is automatically adjusted based on the total number of miners trying to solve the current puzzle. It's a terrific example of some, harmonious economic incentives. Miners are incentivized to compete to find puzzle solutions. The winning miner gets a prize. That's their incentive. The Bitcoin network gets verifications that the transactions that were added are valid. And the more competitors, the greater the integrity of the system. So we now know enough to explain the entire cryptocurrency Bitcoin system. And we can walk through the kind of block and puzzle cycle again, tying these ideas together. There's a bit of a chicken and egg syndrome, though, because where exactly do we start? So let's start at the beginning of a new block. So all over the world, each node is updating its version of the spreadsheet. The nodes are aware that a solution was proposed to the previous block's puzzle. The nodes are aware of all the specific wallet-to-wallet Bitcoin transactions that the previous block verified. The ledger, their copy of the spreadsheet, is now up to date, and we now know the current status of every single Bitcoin wallet all over the world. We know how much Bitcoin is in every single wallet. So now it's time to start the next block. A new puzzle forms based on the previous block's puzzle solution and transactions. The miners, they now know their next target output. They now know what they're guess and checking in order to solve. So if we think back to Plato, the target output pattern has now been made apparent to us, but who knows what random lump input looked like to create that output. We now need to start guessing and checking to find that. Every miner on the network is now racing to find the solution. There's Play-Doh everywhere, we'll say. And after a few minutes, someone solves the problem. Eureka! A correct input has been found that solves the current puzzle, and that's proof of work. It's sent to every single other node on the network, to all of them to individually verify, like see for yourself. This particular input that I just discovered solves the current puzzle. They then try out the solution for themselves. Did the proposed solution actually solve the puzzle? Did this random number input actually create the desired output? The math doesn't lie. Verifying these proofs of work is a very objective, math-based process. And so a new block is then appended to the blockchain. All the nodes, they reach a consensus that the solution that's been proposed, that the proof of work that's been proposed is valid. Now, an interesting thing that I don't think I've touched on yet is that when the new block is appended to the end of the blockchain, technically it doesn't have any transactions in it yet, because the winning miner gets to do two things. The first is that they get to pack the new block with their choice of transactions that are waiting to be added to the blockchain. It's because some transactions, they come with little fees, little finder's fees, in order to entice a miner to include those transactions into the next block. Those fees go to the winning miner. And second, the winning miner gets to claim a bounty of their own, a bounty of Bitcoin, by appending one extra transaction onto the end of the block that specifically says, Jesse mined this block, and now Jesse's wallet gets 1 Bitcoin. Jesse's wallet gets to claim the prize. So in that way, I guess all parties win. The winning miner gets Bitcoin as a reward. Cool. The network as the whole receives some concurrence that the ledger is accurate and up to date, vital to maintaining trust in the network. Importantly, since many miners are racing for the reward, the block gets verified in a very timely manner. Right? So the individual wallet owners, they don't need to fear that their transactions might get stuck in limbo. Every 10 minutes, a new block goes up and their transactions are verified. So when one door closes, another door opens. Now that the previous block has been mined, has been filled with transactions, that means that all the data is there to start the new puzzle for the new block. And that competition for the next block has been started. So now, all over the world, each node updates its version of the blockchain to include the most recent block. The nodes are aware of the solution to that block's puzzle. The nodes are now aware of all the Bitcoin transactions that have been packed into that block and have been verified. Ledger's now totally up to date. We know the status of every Bitcoin wallet in the world, and it's time to go on to the next block. We have a new puzzle to solve. I know that many of you still might have a bunch of questions and answers. So if you're interested, in the show notes, I link to this article explaining Bitcoin in simple terms. At the end of the article, I list out a bunch of questions and answers like, can Bitcoin really last? Will people really use it? Why are the puzzles even needed again? What if a node chooses to stall? What if someone tries to change an old transaction? Is Bitcoin really unhackable? How would I even spend Bitcoin? Here's a big one. What if I need help with my Bitcoin, right? I can go to the bank if I need help with my bank account. What if I need help with my Bitcoin account? All really interesting questions. Can I become a node? Can I become a miner? Is Bitcoin a good investment in the first place? What about all the other cryptocurrencies, right? There's thousands of alternative cryptos called altcoins. So I provide some answers to all those questions. I won't go into all the answers right now because Lord knows this episode has already been long enough. For what it's worth, the last thing I will say today is I really appreciate the feedback I've been getting. I sent out a survey to my newsletter audience over the last month or so, and a few hundred of you responded, which I'm really grateful for. And I will say the two takeaways that I will begin implementing, I promise, after in the coming episodes, the two big takeaways are that slightly more frequent episodes. You're asking for slightly more frequent episodes. So we are about to adjust to 3 episodes a month instead of an episode every other week. So that's exciting. And then some of you said that you enjoy the length of the episodes. Some of you said that you wish the episodes were all a little bit shorter. So I'm going to make a pretty conscious effort to keep episodes to maybe between, call it an average of 40 minutes, 30 to 40 minutes on average per episode. So you'll see these changes coming your way soon. As always, thank you very much for listening to Personal Finance for Long-Term Investors. If you want to contribute a question to a future AMA episode, simply send me an email to jesse@bestinterest.blog. Oh, and on that note, I will say in the new episode format, because we're doing episodes 3 a month, every month, one of those 3 episodes will be an AMA because I think they're my most popular episodes. You guys really seem to enjoy them and enjoy submitting your questions. So we'll now have monthly AMA episodes instead of one every other month. So stay tuned for that. Talk to you soon. Bye-bye for now.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.